Because I have made you the host.
I've clicked it.
Yes.
Yes.
Okay.
Uh, Good evening. I welcome you all for our webinar series. The topic for today is emerging trend in IBC laws and its interplay with tax laws. And the speaker for this interesting topic is none other than our very own Mr. Arvind Pandian, Senior Advocate. Sir, thank you so much for accepting our request to take this session, which is uh, one of your most favorite topics, I understand, and the subject which you do. Yes, sir. So, sir, before we start with the session, as you are aware that we always have, after the session is over, we have an interacting round where questions and answers will be asked, sir. So, depending on your time availability, sir, so we'll take up a few questions. And to all the members, I request you to kindly keep your audios and videos muted. Sir will be doing a PowerPoint presentation, and at the end of the session, sir will also share the presentation with us. So thank you very much once again, all to join this evening, and thank you, sir. It's all yours, sir, to start the session. Thank you, sir.
Thank you very much, Prithvi. First, I must thank Mr. Pramod and Mr. Natarajan for having given me this opportunity to share my thoughts in regard to my understanding of the subject. I would like to have a few disclaimers. Firstly, this is my own way of approach towards the topic. Right or wrong, I think either there are precedents or there are only still issues which are open. So we are yet to see certain areas requiring more clarity and more interpretation of law as we go. The tax laws in regard to this particular topic, I have also tried to add wherever direct taxes also a little bit. I've concentrated more on indirect taxes as a concept, but based on IBC as such. Having said this, I would like to make my presentation in the form of a PowerPoint itself, which helps me to, I would rather say, put my thoughts instead of being it too extempore, placed it in the form of a formal presentation itself. So the comprehensive part of this topic I have divided into 6 parts. Since tax liabilities emerge at distinct stages throughout the insolvency life cycle, the understanding when and how these obligations arise is critical for resolution professionals, creditors, tax authorities navigating the IBC framework, more particularly also tax professionals in the context of today's topic. Having understood IBC, these 6 stages are: CARP is the corporate insolvency resolution process, which starts by virtue of applications made to the NCLT. It virtually has 6 stages depending upon whether we go out of it or not. So before the insolvency admission happens, we call them as pre-CARP. Once the admission happens and thereafter continuation happens, it is during CARP. Then once the CARP is over, then post resolution plan, if a plan is approved by the NCLT. Assuming a plan fails, then when the liquidation commences, how during the liquidation, and then post sale in liquidation, what are the liabilities, and finally once the liquidation is also complete, the last stage, which is dissolution. So I virtually packaged each stage separately to give my views. I'll just try to take it, if possible, each issue wise itself or topic wise, as I put under the 6 subheadings. So the pre-CARP tax dues, trying to understand this particular one, that is before admission into the corporate insolvency resolution process. So these are typically the tax liabilities or obligations incurred by this company or the corporate debtor, as what we call, before the insolvency commencement date. So the insolvency commencement date in the context of a corporate insolvency is the date on which the NCLT admits the company into CARP. It is like into the old act. I think Mr. Rajendra was
Request,
please.
request all of you to mute yourself, sir.
Yes. So the corporate insolvency commences similar to the old Companies Act, where a winding up petition is admitted to make the winding up process start. That is deemed as the commencement date for winding up, the date on which winding up was commenced. Similar to here, insolvency commencement date is the date on which the winding up order, the insolvency order is passed by the Honorable NCLT. Now, during this process up to that date, whatever are the tax liability outstanding as on the date of the admission into insolvency are classified as operational debt itself. When you see the definition, which I'll be taking you through, and this is subject to other procedural requirements, that is filing of the forms as such, which we will see under the IBC framework. So for this purpose of understanding what are the tax liabilities during this pre-CARP liability, these are treated, as I told you, as an operational debt under the IBC. These liabilities face unique procedural requirements which are significantly impacted by next concept called as a moratorium. So for this understanding of what category of debt this is, the pre-CARP debt qualifying as tax dues are under operational debt defined under section 5 clause 21 of the code. 5 clause 21 says even the liability of tax payable, both direct, indirect, or any taxes which include GST, income tax, and statutory dues, something like the corporation payment or the property tax payment, all that which are incurred before the insolvency commencement date, these all fall under the operational debt status defined under 5 clause 21. Now, once they fall under this, there is a claims process. So the claims must be filed with the IRP or the insolvency interim resolution professional, or the RP in case the IRP is confirmed, or the committee of creditors appoints the confirmed IRP or a new RP. He treats or gives treatment of this dues, which is in the form of a debt admitted, qualified, and included in the, I would say, admitted claims, which he advertises or gives to the prospective resolution applicants, who will have to understand these amounts while framing the plan or resolution plan. So this claims not admitted or included, or I would say extinguished upon the approval of plan, they will be treated accordingly, if I may say in one sentence, as per the plan. So for example, if a claim is admitted in regard to tax dues, but in the final plan, all the liability is supposed to be extinguished because these are operational debt, then you will not have a chance to have even a single rupee. You stand like any other supplier insofar as tax dues is concerned. Finally, during this period, that is from the admission of CARP, you have the during CARP, which you'll be seeing, this moratorium impact comes in. The date on which we saw as the insolvency commencement date, on the same day, section 14 of the code imposes a comprehensive moratorium that states all legal proceedings no doubt get interpreted differently in different situations, but surely recovery actions for pre-CARP dues, that is before the insolvency commencement date in stage 1, which we saw, all that get automatically put in abeyance. So these claims must comply with the time limits prescribed in the IBC to preserve creditor rights. That is, if a claim is sought to be filed within a particular time as per the rules, you must file it. If there is a rejection, you have to take it to the NCLT and ensure that you preserve your rights. Otherwise, the creditor loses the rights, in this case for tax dues, because you're talking from the department angle. How does this work? There's a lot of difference between assessment versus recovery, because assessment could be deemed as a legal proceeding, recovery as a recovery proceeding. So the IBC framework creates a fundamental distinction between tax assessment and tax recovery. While this assessment proceedings determine the liability per se, recovery actions face significant restrictions under the proceedings, because as I told you, the moratorium works. Now, what is the purpose of assessment? We determine the tax liability through the process. And timing is as per the law. If I may just add, though it will come later, there is no bar for the assessment proceedings to continue. But as you see in the bottom right, recovery under IBC, that is enforcing the collection of this assessed tax, is within the insolvency framework. Even though it relates to period prior, this could be triggered by the insolvency proceeding also. But however, the moratorium and the claim process. So if an assessment gets completed, the authority should immediately file the claim and say that the assessment is completed and place it before the RP, or even in case of liquidation, we'll see it later. but for the RP for the present because it is during moratorium. Now that brings us to the step, because insolvency commencement date has commenced. What happens to tax dues during the resolution process? Now this is where I must also say many of us have different views. I have had my own view and this got debated a lot. Many of us had participated also in the High Court proceedings in regard to how to treat during CRP dues major and how they are to be treated in regard to plans, liquidation, or even sale, various other issues. All of us have placed our submissions. So that having said, different views come in different scenarios for each particular, I would say, context of tax, particularly GST and income tax. So these obligations arise once the CRP commences. Now, for giving an example, CRP tax dues which arise during the CRP process means, assuming it's a running concern, and both sale and purchase are happening, or manufacturing is happening, or the business activity is happening, if I may put it in one line as on a going concern basis, then whatever taxes arise during that CRP process, they are immediately liable to be paid because they will form something called as what is CRP costs, which we will see also. So therefore, once CRP commences, the corporate debtor continues the operations under the RP's management. He is deemed like the managing director of the company because the board is effectively suspended. He is like an administrator or a receiver per se under civil law, like how we understand. So the tax liabilities arising during this period receive distinct treatment and must be carefully distinguished from pre-CRP obligations. We'll see post-CRP later, but from pre. So there are now the second stage. We have forgotten about the pre-CRP now. This is of the liability which arises during the CRP. So how does the taxation of revenue during CRP take place? So this tax dues generated from the corporate debtor or the company's ongoing operations warrant some consideration which will be different from the other ones. These liabilities must be analyzed through what is called as CARP costs. Now CARP costs are defined under section 5 clause 13, which also include various expenses incurred to maintain this company as a going concern. Therefore, the taxes that arise during this operations, revenue generated, if the revenue generated attracts or incurs certain tax liability which is to be done, then they would qualify as CRP costs, and this receives priority treatment over any other claims. This includes even if you want to buy a pen or a paper or something to, I would rather say, keep the business going on, then that payment holds complete priority. So tax also falls under one of those components of CRP costs. Now this historical precedent, I will say, comes from Companies Act also, not directly, because we did not have the stage of company being in insolvency and then going into winding up or liquidation. We had under 56 Act only company going into winding up straight. So there was the statutory central government official called as official liquidator. So if official liquidator was there, what is the treatment of tax under the Companies Act and the Income Tax Act and the old Act? They were crown debts. So priority was there. Now priority has been pushed to virtually operational debt. But the context in which we say here is, assuming the official liquidator was running the business, then he is liable for the tax liability is what? These three judgments which are in the case of official, which are official liquidator, Bangalore, SV Kondaskar versus VM Deshpande, and ITO versus official liquidator. So these judgments give a guidance also in the context of CARP, subsequently liquidation, how they are to keep these costs. So the context alone is why I placed the judgments here for the purpose of understanding what dues arise during CARP. So these are the components of CRP. We are more concerned about, I would rather say, taxes which come under 4, but also under 3. If you see, the 5 components constitute the corporate insolvency resolution process costs as a CRP cost. One is interim finance, whatever finance they raise for running the business. Sometimes what will happen, because of I would say, the networking capital, or what we call as the gap in the profit and loss account or the running day-to-day affairs of the company, a little bit of finance would have helped. So the RP has the power to raise interim finance. That interim finance is called as CRP cost because he is raising it for the purpose of business. Insolvency professionals fee. It is also in the old act and the new act that the liquidator costs have to be paid for, same way insolvency professional fee. Business running costs, the operation cost of salary, bills, everything.
Sir, I'm sorry to interrupt, sir. 1 minute. I'm sorry, sir. I request all the participants to kindly please mute their mics. A few mics are on and there are disturbances in between. So request all to kindly please mute the mics. Thank you. So sorry, sir, please.
Not at all, not at all, not at all. I think Ms. Maitri is still not muted yet.
1 minute.
A request Maithili ma'am to kindly mute your audio.
Yeah, thank you. So
Thank
the
you.
fourth one is government facilitation cost. This is where, for the context of our topic, cost incurred by the government to facilitate the insolvency resolution process, including administrative and regulatory support costs. Now, this may look like a very vague one, but taxes technically seem to fall under here because when you do for the purpose of item 3 and 2, 3 and 1, there is a
actually the approval எல்லாம் வாங்கணும்
Sir, I'm sorry once again.
Sir, as a
can-
host, you can mute all the people because I'm not the host. As a host, you can mute all and you
Okay.
unmute yourself.
Arvind Pandian, sir, I think you can mute everyone, sir.
I don't know, I want to do that, but anyway, I'll
Just
try.
click on the participants,
Yes.
Hmm.
You want me
Okay.
to do it?
mute all, something will be there.
Mute
Yeah.
all options, sir, and then you
Shall I
can
mute?
unmute yourself.
Shall I mute all for the moment?
Yes, sir.
Even you'll get
Voice
muted.
clear
Don't
ஆகுது.
worry.
I will get muted, but then you can unmute.
Fine. Thanks. I muted all. Thank you. I muted all. After this topic, whenever I'll just unmute it. So the fourth and fifth, fourth is what we saw. IBBI, then the last category specifies which are supposed to be also treated as IBBI costs. They come out as notification from time to time. So the tax compliance during CARP, how it happens during this process. This is RP's personal responsibility and he has a comprehensive responsibility for managing all statutory tax compliance throughout this period. It includes both ongoing obligation and also addressing the new tax liabilities that arise for continuing the business operations. So what are the RP's statutory liabilities? Now when RP's appointment date is known, then till the CRP concludes, he is to comply with everything. For the purpose of the statutory compliance, he is required to file, if you see, the GST returns, income tax, TDS, and paying all the applicable taxes. TDS must be deducted and deposited for all payments made during CRP wherever applicable and appropriate. So far as the new liabilities and moratorium scope, new liability is during the period which is running also. So on these transactions, that is like property tax, GST on sales, whatever is the going concern sales, he must pay it during the CRP period as a CRP cost, which will then be recovered through the resolution plan. When the moratorium is there, a recovery of prior dues is prohibited, but does not exempt new liabilities incurred during CRP. Now I leave it open because that is where the controversy was also there. What about the new liabilities which have been created? That's a moratorium, I would say, or the plan, if it is included or not included, whose liability. So the RP is duty bound anyway to pay taxes accrued during the CRP, even under moratorium protection. So this liability, both direct and indirect taxes, if we may all have to agree, this is where the insolvency code ensures that all taxes, we understand them as direct and indirect, are to be paid. This is the during CRP process. So the direct versus indirect taxes, there are slight, I would rather say, distinctions between the two. When it's a going concern, the nature of tax liability, that is between the direct and indirect, it fundamentally affects the payment obligations and fiduciary duties. Here we are talking about the fiduciary duty of the RP. So failure to properly handle the indirect taxes can constitute unjust enrichment, because direct taxes is if there is a profit, only then it technically comes. Otherwise, the question except TDS, it doesn't arise. Whereas indirect tax immediately brings about a liability. So if you see on the left-hand side, in regard to revenue generation and tax type, in indirect taxes, that is GST and VAT, the corporate debtor itself acts as a collector of taxes that are ultimately borne by the consumers. These funds do not belong to the company but are held in trust for the government, similar to pre-CARP. Whereas direct tax liability depends on the revenue surplus generation, and these taxes are specific to the corporate debtor's income and profits during CARP. As I mentioned, duty to pay an unjust enrichment, if the RP or liquidator happens as you saw after liquidation, if he collects the indirect tax, they are duty bound to remit to the tax department, and failure to do so would constitute, please see for whom, it is not for the RP, it would be an unjust enrichment to the committee of creditors or the successful resolution applicant if it is CARP, and or the auction purchaser if it is the liquidation status. There could be a purchase also through a resolution plan, no doubt, but there's still a plan. So for this purpose, the recovery mechanism, the unpaid indirect taxes could be recovered also from the COC or the SRA, or SRA is the successful resolution applicant or auction purchaser to whom these funds were passed. The appropriation of such funds would be in breach of fiduciary duties, one of the principles framed in the first earliest judgments in the Swiss ribbons. It was a passing reference, not in the context of tax. There cannot be any kind of benefit made by the COC in violation of their fiduciary duty in Swiss ribbons case, reported in 2019 4 SEC 70. So recovery of incorrectly appropriated funds, if they are done, what is the method of recovery if this happens? So the liability is determined individually for the SRA or COC or auction purchaser based on the specific performance of each case. Once the RP feels that this is what has happened, NCLT is approached, who alone have exclusive jurisdiction over all recovery efforts related to CARP proceedings. Now, there is a very thin gray area as to in what situation a writ petition will apply or in what situation an NCLT proceedings will come. Normally, if this has been unjust enrichment, it is only a apportionment and rearrangement of the amounts which have gone from one hand to another, so they can collect it and remit it back to the government. That is why they say NCLT is the process, because they were the one who actually framed the plan or have approved this liquidation sale. So this fund recovery process, if you see, the COC must return funds retained from the CARP or liquidation, because the financial creditor who form the COC, they are the ones who get the end use of the funds by virtue of this process. However, if there is a post-assessment recovery executed, then that is also through NCLT application, meaning the department can also go and file an application, whichever department, it's a GST department or income tax department, and say that these funds have been wrongly allocated by the RP or the COC in this manner, which has landed in a particular of these three categories of persons, and the money is to be paid to the department, and the department can also move if necessary. So these direct recovery mechanisms, NCLT may direct COC, SRA or auction purchaser to refund. I'm using the word misappropriated without any intention, because they are all entities coming through the act, following proper assessment and determination of liability. Now the assessment meant here is by NCLT going through the papers, not through a regular reopening or in any manner under the GST or the tax acts. So the liability for surplus, as I mentioned, the auction purchaser or SRA remain liable for surplus, because COC would have got, assuming for a moment, their rightful money, but they have not been, I would rather say, appropriated by these two. Then these two become liable, that is the successful resolution applicant or the auction purchaser during the CARP or liquidation proceedings. So the clean slate doctrine is when, assuming this distribution has been completed as per the previous slide, on that day there is no other liability which is outstanding regarding the dues mentioned in the plan or the cutoff date with the CARP cost arrived at on that guillotine. So what is a clean slate doctrine and direct tax implication first? So the SRA gets a protection under this theory of clean slate. We'll come to the judgments and the critical view which is being continuously taken. So the SRA, the concept itself has come so that the SRA doesn't get burdened with any new tax liability, and on the date he is applying for the plan, he knows fully the gamut of outstanding dues which are there, and therefore he is ensuring that he doesn't take any further liability, and that is how the clean slate theory was originally envisioned. The COC, assuming for a moment, has kind of got some opportunity for the purpose of disgorging these funds that rightfully did not belong to it, then that tax liability on surplus generated falls on the RP, that's wrongly put as professional, resolution professional, which shall be claimed from the estate of the corporate debtor. So the corporate debtor estate is whatever has gone. So that money alone, the COC will ensure that it will be paid out of it. Then limitation on cash liability. So liability is strictly limited to actual cash received by SRA or auction purchaser from the corporate debtor operations during proceedings. So the clean slate theory of the past dues will be limited only to this, or if there is a complete wipeout. The distinction between this is the recovery approach applies exclusively to dues arising from, please note, CIRP or liquidation operations, and does not extend to pre-CIRP tax dues, because there is a wipeout in the form of clean slate. So the COC is liable, in my view, for tax collected as per the resolution plan and the RFRP. RFRP is a document which is the one which gives the terms and conditions of the plan to be given with the NCLT, and NCLT will examine each case. So if the RFRP discloses a particular request for resolution plan, RFRP full form is request for resolution plan. So when somebody wants to participate to become a resolution applicant, they give an RFRP, a request for resolution plan, make the minimum payment or the deposit, and then get the plan, get the document, and in this document all the assets, liabilities, taxes due, everything would be stated. Looking at that only, he is supposed to apply, and the NCLT will examine this to see whether it is a pre, during, or a liability which is disclosed, or if it is disclosed, what forms part of the liability of the RP, what forms part of the liability of the COC, and what is for the SRA or the RA, who's we call them as PRA at that point in time, provisional resolution applicant, at that particular point in time, whose liability is what. While doing this, the difference between the Income Tax Act and the IBC, you will see a little bit. 233 of the code, insolvency code, protects the insolvency member, the government or board members, that any action they take in good faith. Now that's become a matter of dispute of late. Has the RP done it in good faith or the liquidator done it in good faith? If he has done it in good faith, he is protected. But if he has not done so as such. Whereas if you go under the insolvency code, the RP is protected under the Income Tax Act also now, unlike the company liquidator. Under 178, if you see, a liquidator is personally liable, 178 Income Tax Act, liquidator is personally liable for all tax dues, and he can even be proceeded with if he has not properly paid the tax. But however, 178(6) has been a non-obstante provision given subsequently, wherein they say, however, this does not apply to RP under the insolvency code, and he is protected if he has acted in accordance with the code. So therefore, there is a slight distinction in the context of direct taxes itself, income tax and other acts versus insolvency code for the liquidator. So the committee of creditors' role in tax liabilities. So that if you see, the COC is the one which approves the expenses. Day-to-day expenses are approved by them. If it's a running business, it's absolutely no problem because cash gets generated and it takes care of other expenses as it goes. So because the bank is not asking, or the financial institutions are not asking their money, there is enough day-to-day, I would say, available cash to ensure that the operations run. The operational costs are available. But however, they give liability to, they give rise to liability. Now, these tax liability is statutory. Here, the COC, bank, IBC, as I told you earlier, cannot take the exemption saying that they cannot pay the tax because of moratorium. However, the tax liability is a statutory one, and this is not to be approved by COC, or they cannot say. IBBA gives a circular and says, whatever are the tax liability which arise during the control of COC and the RP, if it is a liability which form part of CRP cost, please pay those liabilities. So they are a statutory liability. In case there is a contravention of law, the COC does not have any commercial wisdom to say that this issue of payment of tax, which is a statutory obligation, is right or wrong. Any decision which is contrary to the payment of tax which they are liable to pay would be invalid, and that liability which they have not properly shown will amount to a violation of section 30 clause 2 clause E, because 30 clause 2 are the mandatory conditions which they must satisfy if a resolution plan is to be appropriately valid. Clause E specifically says that a plan should not be in violation of any laws. Any law naturally includes income tax law or GST law. So if the COC has taken a violation and treated a non-payment of tax, tomorrow when a plan is approved, any third party can always say that this is in violation of law, and the whole plan can fall like a pack of cards in a domino effect and can fall to the ground. So the COC should be very careful. In fact, of late, almost all COCs have very high quality tax or corporate professional firms as their advisors. They take immediate advice on a regular basis, call them as invitees to the COC meetings, take written opinions from various professionals, and then only decide to avoid this. Otherwise, the whole plan will fail. So the key principle here, the tax liability is implied when the COC resolves to run the corporate debtor as a going concern, including all associated tax implications. And the COC has no authority to approve or disapprove tax expenses arising during CARP. So they have to run it like, it's like, except for there being a statutory body like COC, it is like any other company run by the same old owners or promoters as what we call. Now, filing of returns and representations, the RPs and the liquidators' ongoing duties, we saw earlier, they are responsible for managing and pursuing all the tax assessments related to the corporate debtor. They must seek the assistance from the SRA if the plan is approved, who controls the relevant documents and record, because if the plan is approved, everything would have been handed over to them. This duty is traced to Regulation 39 capital A of the CARP regulation regarding the document retention requirements, and similar Regulation 6 clause 2 for the liquidation stage also, if they are to maintain the records and file. So the RP or liquidator who maintains continuing obligation for tax compliance, filing returns, and representing the corporate debtor before tax authority throughout the insolvency process. So what is the impact of the resolution plan? We saw the term the clean slate theory. One of the earliest one where this was envisaged was Ghanshyam Mishra versus Edelweiss Assets, where Supreme Court confirmed that tax liabilities are operational creditors up to the CARP initiation date. As we saw, that is the pre-CARP as what we saw. And income tax is an operational debt. And income tax liability forms an integral part of dues to the government authorities under the IBC framework. So what are the binding effect of Section 31? Section 31 is, 30 is the components of the plan while approving the resolution plan by the NCLT. Section 31 is on whom all the plan has a binding effect. Firstly, on that 31 approval, the binding effect as per this judgment is, claims are all frozen. There is no other new claim, and whatever claims in the approved plan which are frozen are binding on all stakeholders. Stakeholders are much wider than the term called shareholders, creditors or so. All other claims get extinguished which do not form part of the plan. No further proceedings for this unapproved claims as part of the plan can in any manner be initiated. What is extinguished gets extinguished completely. So the government dues as secured debts. Just for a minute or a few seconds, if I may take, this is the biggest change if we find from the old act to the new act. Companies Act 1913, Companies Act 1956, which administered the law of winding up. We always used to know, people who have been from the old generation, Companies Act, crown debts, tax dues are crown debts. But the biggest change under the insolvency code is the crown debts, as what we call, were all pushed to the lowest level, and the financial debts were made as the primary or the premium ones. So the government dues became no doubt secured debts, but they went down as operational debts, which we saw earlier. But Rainbow Papers ruling by Supreme Court in 2022, SEC Online 1162, this held that the state act, that is state tax authority, again there is two state, qualified as a secured creditor under GVAT. So Gujarat VAT Act also kind of considered this, because the act had a particular treatment already given. So if the state acts give a particular treatment that they must be secured debt, it will be treated as secured. But however, it does not mean that they automatically qualify as a financial creditor. They still stay in the waterfall mechanism lower. But while preparing a plan, this has an important aspect. So the first priority treatment to be treated at par with a first priority under 53. Now 53 is a provision which is a waterfall which comes under the winding up or the liquidation process. But when you frame a plan, a resolution plan, the law says under section 30 and 31 of the Insolvency Code that a creditor should not get lesser than what you had got under 53 in a liquidation. If I may just repeat it again, that's one of the fundamental principles. A creditor should not get lesser than what you would have got in liquidation itself. You must at least get the same amount or higher. So that is what, even if a first priority treatment is given, if he is supposed to get it in liquidation, operational debt, 0 if there is no money available after paying the financial creditor. Then it's the same thing, it doesn't matter at all. So the secured creditor definition gives only one, if you see, one with a security interest created in their favor. Income tax liability now is considered a secured creditor claim. It is like an attachment or I would say a charge on the property technically. However, the current practice, if you see, subsequent to that, the next Rainbow 2 is limited to its facts, and they clarified it that it does not extend to all cases where a statute does not contain a provision akin to the one in GVAT. We do not have, the State Act, Tamil Nadu does not have, as was the case in Rainbow. The priority or treatment of secured creditor is not given to the revenue. For example, this is the latest judgment also of Supreme Court after in the similar situation, Viber Goel versus DCIT, Civil Appeal number 49 of 2022. Now that brings us to the third stage. So we have seen pre-CARP, we have seen during CARP, and now we are going to see post-CARP. Now post-CARP are in two situations. One when a plan is approved, and another one if the plan is not approved. Let's see the plan approved status first, which is a resolution plan. So here you will understand the tax obligations and various compliances following the implementation of an approved resolution plan. That's the context in which I'm placing for a post-CARP. So the RP during this period, CARP period also, he would have got a GST registration. I didn't put it there because here he must surrender that or cancel that after the CARP concludes, and he will subsequently hand over the compliance to the new person. Then the new management gets a responsibility, which is SRA, for all ongoing tax compliance, and he will get a fresh GST or a registration and continue further. Then the CD must obtain the fresh registration and file GST returns under applicable tax laws. And regarding remission of liability, insofar as direct taxes, I do not want to expand this more. The Mahindra and Mahindra judgment as to how to work out section 28(4 when a debt is written off, how taxation is to be done, is still post the latest amendment which happened, is still a grey area which requires clarity. Because now CARP you saw before this had completely written off all the debts. So how this is to be viewed will be a situation later. And last one, MAT, the liability and all the waivers, how they are to be dealt with under the provisions of Income Tax Act. These all will be some of the areas which we will be considering now regarding the post-CARP tax liability. Tax refunds for operational creditors under IBC is a very interesting concept. What happens if only a partial amount is given to the creditor, and how to give a refund or kind of claim the, I would say, return of some particular credits which we will see in regard to operational creditor who have now agreed to accept reduced payments. Because right now they, instead of getting 10 crores or rather I would say 10 lakhs, is only getting 1 lakh. I'll give an example also as you go in one of the slides. The plan gives only a portion. Does that give them a right? Yes, they gain a right to claim tax refunds for the portion paid on the remaining 9 lakhs also out of 10 lakhs. So the differential between tax paid on originally billed amount and tax on actually received amount creates this refundable surplus, which the department must acknowledge and proceed, I would say, process. So for this, if you see the judgment of the Orissa High Court, which ensured that the operational creditors accepting reduced payments can also claim corresponding tax refunds on the unpaid portion. Also, similarly, in the Bombay High Court, in the case of GGS Infrastructure, they also affirmed that tax liability adjustments must reflect the actual economic transaction and not merely the original invoiced amount. So what does this give right to? The right to refund survives. So the discharge creates also some of the rights, because the successful resolution plan which has been approved by NCLT, the corporate debtor alone is discharged from all the pre-existing liabilities. This discharge will operate as a deemed fulfillment of its obligation alone, but however creates a legal fiction that a debt has been satisfied. That's all. This critically, however, the tax department cannot claim all liabilities extinguished, and the corollary rights include the statutory right to claim refunds, which survive and vest in the assessee, which we just saw. Though Orissa High Court, in this judgment which we saw in metallics, that particular has held that refund of past tax is not allowable after the resolution plan sanction. That's a very nice, interesting situation, because it's a pre-CARP tax refund to the corporate debtor, pre-CARP tax refund for liabilities which arose before. So if you use the clean slate theory, as much as you say that all liabilities wiped off, the refund also gets wiped off as a concept. So that is an interesting one. So if a company is trying to claim that this refund is an asset and they have also got it through a plan, it depends how the courts will interpret. Will this, see, clean slate theory only wipes out a liability. We can also argue clean slate theory also wiped out a past asset like this, which is a notional asset receivable from the past dues. So there are divergent views. The Rajasthan High Court also holds in Ultratech that the extinguishment and liability does not negate refund entitlements. So there is a divergence of views slightly. Orissa, Bombay, Rajasthan taking a slightly different. We have to wait and see how regarding past refunds, when they come in, how are they to be treated if there is no provision in the plan. If there's no provision in the plan, in my view, automatically gets wiped off. If it gives the provision in the plan that the SRA will get this refund, does he have a statutory right to get? Because if the clean slate theory wipes out, clean slate theory is no doubt not a legal theory for falling from the insolvency code. It's a Supreme Court judgment evolved law. So that way, the concept should be explained further in this regard for refunds also. Reassessment under Income Tax Act post-resolution plan. High courts consistently have held that post-resolution plan reassessment proceedings will violate a clean slate principle. So you cannot, in fact, that's major point which is being argued in most of the proceedings. The tax authorities cannot initiate fresh assessments for periods predating the approval of the resolution plan. This is a judicial consensus also by all high courts, preventing the resurrection of claims that should have been filed during the CARP. So the department is bound to, like any other creditor, file their claim. If they have not filed, they cannot seek the, I would rather say, recovery through a reassessment. Similar situation took place in the Madras High Court under the Dishnet Wireless. The other high courts which have taken, as I said, different view. But Dishnet Wireless is now under stay before the division bench, and we can await and see how they also fall in line with other high courts or take a different view. Lastly, the carried forward losses. It's a very interesting concept. Many NCLTs are taking different views. Pre-CRP tax losses are typically carried forward to benefit the resolution applicant, because sometimes what they do is they have not taken over the company only for the purpose of the business. They have also taken over because there is enough carry forward losses there. Now the Income Tax Act has been amended enough amount to show how the carry forward losses can be taken. But however, I am constrained to say the NCLT frowns upon this nowadays, because they find that plans are being envisaged in, like how mergers used to take place for buying losses. Now plans are also being done for taking over losses. So the NCLT, if it specifically says that losses are not to be taken forward, losses cannot be. And it cannot be argued, I have a right to take over the losses. The NCLT feels, no, I will give you only this business. If you want, you take it. You're not paying for the losses, you're paying for the business. The losses can be written off. So some of the NCLTs, which have very tax knowledgeable members or former commissioners, are very strict, like scrutiny officers or assessment officers, sitting there and scrutinizing the plans and are disallowing this carry forward of losses as such. So the income tax department and secured creditor status under IBC, which we saw in the first slide relating to this particular stage. So they are a security interest under 3 clause 31, which I mentioned earlier. Under 53, secured debts come under a particular waterfall. But however, if you see the second last line on the left hand side, government dues rank as operational creditors, subordinate to secured financial creditors, and also insolvency resolution process costs and workmen dues for past 24 months. So this is roughly the priority. However, IBC has an overriding effect. So IBC under section 238 can override everything. Now, the overriding will come only when there is an inconsistency. So it doesn't mean that it's a super act. When there are two acts contradicting each other or inconsistent provision, we try to apply, only then the inconsistency applies. So Supreme Court affirms the IBC's overriding effect in this Mona test part judgment reported in 2018. And also that Suvankar Bhomik, also the Calcutta High Court holds tax attachment itself does not confer a secured creditor status under IBC. But you saw the earlier judgments which I showed also. The GST dues and secured operational creditor status, like income tax, GST is also a operational creditor. There is no security interest created here. Unlike the GVAT, GST dues under CGST or state GST acts do not create a security interest as defined in IBC. So rainbow principle cannot be applied to all situations. So the tax authorities cannot claim a secured operational creditor status in insolvency proceeding, despite statutory provision also suggesting otherwise, because 238 prevails. Then operational creditor framework, as I told you, GST also must file their operational debt claim. If I may say, from 2016 when the act came, till about 2020-21, the department itself was under the impression that why should we even file a claim? For them to get adjusted to the procedural compliances to treat themselves as creditors itself took a long time, and enough notifications have come where the department must file their liability. That's why I also quoted the rainbow papers here. If they want to get the benefit, they must also make their filings as such. Slides? How many more slides? Okay. Okay, so the doctrine of clean slate, again, just in this context, you have seen the first and second one, fresh start for corporate debtors, wiping out all past liabilities. I mentioned about 31.1. Now the last one, Hydra-headed litigation. That's the context of a doctrine of clean slate. The Supreme Court itself calls it, if you have identified a liability on a cutoff date, which are all the creditors, which are all the tax liabilities, there must be a finality to this. So a new person coming to take over as a resolution applicant should not find Hydra heads suddenly coming out. Then nobody will come to take over a company. And if undecided claims are going to come forever, it will not be good for economic revival, and it will prevent a complete chaos in regard to perpetual litigation. And Supreme Court said in that context, they framed the doctrine of clean slate. So for this purpose, just for understanding the principle of IBC, how far undecided claims impact can be there, the SR Steel judgment versus Satish Kumar Gupta by Supreme Court will be of relevance. Though it is in the context of general all claims, you will find in para 1, the last two lines, the court employed the vivid metaphor of preventing Hydra heads popping up after the resolution process concludes. That nowadays, in the last few years, if you find financial creditors or operational creditors are not there. But the operational creditors in the form of tax claims seem to be coming later, which now law is slowly trying to get settled.
Exactly.
So the interpretation of doctrine through judgments, you can go through these judgments, Ghanshyam Mishra, Vaibhav Goel and Ebix, how the plan is kind of binding on all these creditors. Let initiate 10 minutes. So the input tax credit and non-remittance by corporate debtors. Now coming to the context of the, I would say, indirect tax itself. So how the CD, that's a corporate debtor, collects GST from buyers, but fails to remit it to government before entering CRB. This is the first stage. He has done the business even before NCLT proceedings commenced, but he did not remit. Then there is a complex situation arising regarding the buyer's input tax credit entitlement. So under the clean slate doctrine, if the tax collected is not remitted and this liability is extinguished through the plan, the buyer's input tax credit is also generally barred, because that also was written off. This also should not be claimed, seem to be the position of understanding, I should say, but subject to all the experts here. The buyer cannot claim ITC when the corresponding output tax was never deposited with the government. Though 16.1 or 16.2 is there, I'm not getting into it. Which conditions ITC eligibility and actual tax payment by supplier? One or two situations for adjustment have come subsequently. So non-remittance, if you see, to balance interests. So should the IBC proceedings qualify as a scenario where the supplier does not have adequate assets to permit ITC reversal by the buyer under GST provision? This is a question framed by the NCLT itself, Mumbai bench, in Abco v. Win Ent Private Limited. And in this judgment, they said that claims for unpaid GST must be filed by the buyer before the RP. So if he has not paid the buyer the GST, he must actually place it before the RP in regard to this during the CRP period itself. Some kind of reconciliation, if you may say, I have just tried to suggest. Absolutely, whether it's anomaly or not, I think the discussion will show. Though there does not exist a mechanism, a practical solution which has been proposed during the tribunal hearings is the benefit of the proportionate recovery should be extended to operational creditors. So, which means if the plan gives 10%, I'll give you the example next once I read this. The GST department should also be directed to provide the same percentage of recovery to such operational creditors as provided under the approved plan. So this approach will balance the clean slate doctrine with the equitable treatment, both the buyers who paid GST in good faith while maintaining the finality of the resolution process. This seems to be somewhat a view from the stakeholders. For giving somewhat, next. Just to give an example, a practical one. The resolution framework. So consider a scenario where 10 buyers each paid 1 lakh in GST to the corporate debtor, totaling 10 lakhs. Under the plan, only 1 lakh is paid to the GST department, representing just 10% of the claim amount. Now on the right hand side, you will find 10% is the recovery rate. This proportionate recovery mechanism, this impacts the input tax credit treatment under the GST framework, which is only 10,000 per buyer. So if it is 10,000 per buyer, which is 10%, he should be given, if you see under the bottom portion which I am showing, each buyer is entitled to 10% of their original ITC, that is 10,000, with the remaining 90% subject to reversal. He should be given an opportunity to reverse. No doubt the operational debtor must have filed a formal claim during the resolution. He must have given this as a claim before the RP. That is, I have not got my input tax credit. He should have filed a claim as an operational creditor. If no claim is filed, NCLTs are uniform. Forgetting whether it's input tax credit or any tax, no reversal, there cannot be any kind of liability and everything will be permanently extinguished. This can be an approach because it is currently lacking how to give the benefit to and regarding input tax credit reversal or refund. Now, I am not trying to suggest anything. This is what we are seeing it. There's something which is possible. It is my personal opinion. I may be wrong also. Now that brings us to the liquidation proceedings. Now during liquidation and post-sale treatment, now the key liquidation phases are given in this bullet. It's only academic. I don't think I'll have to explain this much more. These are coming under section 32 capital A of the Insolvency Code. So distribution of assets, again here, These are the persons who are the 7 categories of people who are from 1 to 7, virtually the order of waterfall mechanism. 1, 2, 3, 4, 5, 6, 7, you will see in the same priority, they get it. We are concerned about the 5th one, which is government dues as such. So TDS compliance under 194 IA as originally understood. So when a transfer of immovable property, because this comes very much contextual, because the liquidator is supposed to sell a property which includes transfer of property. Is he liable to TDS when the amount exceeds 50 lakhs? To reduce that 1%, the responsibility on liquidator, it is an asset sale under 194 IA. There is a TDS on the payments. The non-compliance consequences, this is how it was. Now, is the liability technically there for him to deduct or not? Gets also judicially explained. In this judgment of Company Appeal 624 of 2020, the National Company Law Appellate Tribunal framed the question itself, whether TDS under 194 IA, if at all, arises or is inconsistent with 53 of the Insolvency and Bankruptcy Code. I have given the facts of the case. For want of time, I am not answering it. The liquidator arguments are on the other side. They said that there is no TDS obligation at all, and it is not by virtue of the statutory priority structure, governing the liquidation, there's no necessity for the liquidator to actually do this as such. So that's the judgment in regard to this. You will find the facts and the statutory interpretation given. And the key outcome, if you see, the effect is during liquidation, there is no necessity to do this, is what is the key outcome, to ensure that the insolvency, I would say, proceedings is, I would rather say, kept from other compliances to see a fast resolution of a company. Same way, capital gains on sale in liquidation. It's a very, very complex situation. A capital gain will come, no doubt, when he sells. But the whole problem in the context of what I'm trying to say is the intersection between capital gain. What will be the cost of acquisition? Is it the original cost at which the company actually acquired, or the valuation base which has been fixed by the liquidator as the auction price, reserve price, for the purpose of selling in the valuation report? And then how is it to be computed? Huge amount of dispute is happening in the context of this. And if he has bought it, does the liability, when it gets got transferred, does the buyer get to the cost of acquisition of the original cost or the valuation cost per se? So this, I would rather say the consistency of judicial position upholding this, there are conflicting decisions on this. I just highlighted this for the purpose of flagging it. Courts have definitely clarified that the IT Act requirements in liquidation scenarios is very much essential. But Supreme Court in Mona Tespad and you saw Om Prakash Agarwal, that Section 238 has an overriding effect. But I would not like to argue the overriding effect at all. This is only on identifying the actual cost to arrive at a capital gain event. The capital gain event is not applicable to liquidator, 100% accepted. But how is it tomorrow if the buyer is further going to alienate it? It is in that context. Surplus distribution and dividend distribution tax. Tax implication, voluntary liquidation. Now, voluntary liquidation, they cannot take the regular liquidation because that is an involuntary liquidation. Here in voluntary liquidation, if you see now, the capital gain component in the bottom, I've clearly said it has to identify the fair market value at the distribution date and the shareholders' original acquisition cost of shares. So it is not easy in a liquidation done voluntarily to get away from the income tax liability, and the dividend distribution tax under 2 clause 22 very much applies in the context of it, and the IBC code will not so easily, because voluntary liquidation under 54 is a slightly different context. Future implications also in this regard are to be seen, because subsequent sale by the distribution of the asset, because sometimes what happens, you don't receive money, you will get the asset in specie. If it comes in specie, tomorrow if I am a shareholder and I got it in specie, what is my cost of acquisition for the purpose of computation capital gain later? That is the context, and in voluntary liquidation, the interpretation seems to be the original cost of the company. So these are all the compliance obligations of the RP regarding filing of forms. You will find that the GST compliance and TDS, which are all the forms which have to be filed, there are 4. Next one. So effectively, which are the provisions under the code as well as the Finance Act for the purpose of this trigger. Section 288, the provisions of law, the rules as such for the purpose of filing. So demand adjustment under IBC, this is the last topic for me. I will just complete this in another 5 minutes. I know I've taken enough time. It's almost 50 minutes. How many more? 2 or 3 more slides? How many more? Okay, fine. So modified demand, the moment a plan is approved, the section 156 capital A of the Income Tax Act clearly says that the AO should modify and pass an order in accordance with the A, that is adjudicating authority, which is NCLT or appellate tribunal or Supreme Court, in regard to the one which is done. Nice. So these are the provisions of 156A we just saw, 178(6) in regard to the liquidator's liability, and IBBA circular with regard to dispensing with getting an NOC, because if there is an attachment or 281 or 178, any NOC is required. Does it require an NOC? No. IBBA says that you simply proceed and complete the liquidation process without waiting for an NOC in regard to any liabilities there or not which is arising. So the GST compliance framework predominantly falls under this 5 circulars and notifications to ensure that the tax treatment during insolvency are through this particular one starting from 2020 to 2022. The critical, I would rather say, is that indirect tax liability must be ensured that the RP or the liquidator comply with this, because it's an arising factor during the proceeding itself. So the argument that a going concern does not have tax implication during these phases may not be correct, and there is no regulatory framework to support that. For the purpose of reporting and how to treat them and registration, these 5 circulars are most relevant. So the special procedure of those you would have seen in regard to the IRP, that is the first one. The moment the CRP has been initiated, the IRP or the RP obtains a new registration. Pre-CRP dues treatment as operational debt. There cannot be any coercive steps under GST. Third one, input tax credit. The IRP or RP can claim the input tax credit on old invoices in the first return filed under the new registration. Importantly, suppliers can also avail the ITC on such supplies, maintaining the credit chain. So if the RP has claimed it correctly, it automatically comes to him also. Fourthly, the cash ledger refunds are also permitted for amounts that were deposited under the old GSTIN but remained unused at the time of CRP at the commencement of the CRP because he's got a new one. So while clarifying this GST treatment during CRP, the recovery moratorium, no recovery proceedings, continues also for GST. Limited RP responsibility, which we saw, he is liable only for the dues arising during CRP period. He is to ensure fresh registration and to ensure that the tax treatment are in accordance with notification number 11 of 2020, and refund resolution if he is clearly in the pathway, if there is any mismatch or so between the old registration and here, how to claim the refunds. So far as notification number 39 of 2020, the relief measures for compliant entities, this notification amends the earlier one, providing a targeted relief to the specific cases which does recognize or does not recognize that one size fits all, mainly for filing of all GST returns prior to the appointment to the RP are exempted from requiring to obtain new registration. It is in that context, and the notification also extends the period of the IRP-RP to secure a new registration to 30 days from the date of appointment up to June 2020 at that point in time, but making it flexible if it comes later. Then this circular of May 2020 is again relevant in regard to COVID disruption, but not directly in regard to CRP, but because it is also relevant for IBC, because IBC had certain COVID, I just quoted this. And the last one, in post IBC settlement of statutory dues, after the conclusion of IBC proceedings, how the IBC, I would rather say, the demand reduction protocol in form GST DRC 0707A is to be made, and how the commissioner is to issue the reduced demand consequent to this. But however, no recovery action during the moratorium period. So some of the contingent and sub judice claims in IBC. I've just tried to put the old case laws because very few relate to, I would rather say, the new situation. Section 3, Clause 6 defines what is claim under the code. It uses the word all claims, even those that are uncrystallized, contingent, currently disputed in judicial proceedings. So this, one of them is a Calcutta High Court judgment also. And the Supreme Court in Adani also tries to tell that all potential liabilities are addressed within the framework of insolvency. So you cannot have something which suddenly comes after 7 years that this relates. But then it's also a vague situation which comes that if you are trying to ask for the refund as what I claimed earlier, how that would be treated is what. So this is a claim which is a very contextual one. You'll have to decide right now uncrystallized. Assuming it gets crystallized in a judicial proceeding, what happens? And the last stage, the 7th stage, is what we saw, dissolution under insolvency. This is the one where the company gets completely dissolved because at this stage, all assets have been distributed, creditors have been paid, their liabilities have formally ceased to exist, and the company. So the winding up is one situation. In the insolvency code, insolvency is one situation. In the Companies Act, after winding up, the company gets dissolved. The same way in the insolvency, after insolvency process, the company gets dissolved. So the dissolution is virtually the killing of the company. Once it's killed, it is struck off from the ROC's record and there exists no other liability. But if there are any unresolved, we are seeing practical situation. If tax assessments are still continuing, the company will just continue those proceedings as if it has not been struck off till those proceedings are over. But it will, for all purposes, be dead on the ROC record. This is in effect how the tax liabilities survive. I've just tried to put it in 2 lines. In NCLT, there are certain proceedings still continuing for the purpose of getting tax refunds because the refund was supposed to come to the company. We have not yet got into the rigmarole to say that are they entitled to a refund or not, but refunds were supposed to come. So the RPs continue this process during this period. Thank you. This is somewhat the I would rather say, how do I get it out of the, how do I take it out of
Yes, sir.
yeah.
So it was a wonderful presentation, and I would also like to tell that we had the largest audience in this particular webinar series of this year.
I just would like to ensure that absolutely, please, with the greatest of respect to everyone, I have tried to make some way a presentation for the purpose of the benefit of our participants. I know that everyone will have a different view. Each one will have their minute points which are to be raised. My humble request is please treat this only as a presentation from my point of view. All the experts here, please, you will be in a better position to interpret it in the manner known to the case which you are dealing with right now. Whatever questions I'm able to take and answer, I will surely do. This presentation, Prithvi, I will just send it immediately by email to you. You can share it to all the members also. And it may be useful. That's why I didn't read everything. And time was too short. I think I've done longer presentation than what was required.
Yes, but it was more or less in a very simplified version. You tried to show the complicated topics, sir. So it was a very wonderful presentation. Sir, we have a few of our members who would like to ask a few questions or discuss rather.
Please.
Yes, sir. So participants, if we have anything, I request everyone to come one by one. I think I first see Ramana Kumar sir raising his hand. So Ramana Kumar sir.
He's an RP, so he's an interested party. So
yes.
Yes, I am an interested party. I am
a liquidator.
Both an RP. Yes, I am also a liquidator. Sir, it was an excellent presentation. You have taken through what we have tried to learn in the last 5 years in matter of 1 hour. It's a great learning for everyone, including me. Thanks.
Frankly, it was a learning for me also because when we speak only, we also prepare. And when we prepare, we have to organize it. I was also kind of enriched by virtue of the opportunity given by you all. Thank you very much for the opportunity. Please. Now
I have one question for you. See, during liquidation, there are situations where the liquidator have to deposit some money in the bank as fixed deposit, maybe some excess money or money which is yet to be this thing. the banks are deducting TDS or all that. Is there any way, apart from applying to the department, taking a lower deduction of tax, trying to do something by which this TDS is not deducted, even though the account is a liquidation account, specific liquidation account with the bank?
See, the main purpose for which you are deducting is to avoid any kind of penal action in future. Only is, or that fear is why you are deducting. Otherwise, you wouldn't be deducting. You would naturally be.
Not me, the banks.
Okay.
The
It's a
banks
reverse.
on the fixed deposit interest.
I would rather say that unless the RBI or someone gives them a direction like how the department has given based on these judgments that they are
Okay.
regulators are not liable to be done. It's beyond our comprehension, I think, but it must come from the regulator.
Okay. Thank you, sir.
Thank you.
Thank
Excellent
you.
presentation.
Thank you, sir. Anyone else? I saw a couple of more hands raised, but I don't see them anymore. Mr. Arvind Rajagopal.
I see Mr. V.S. Jayakumar also there, ready to
Yes,
answer.
sir. Jayakumar sir is also here.
Arvind, you did very well.
Thank you, Mr. Jayakumar. Sorry, I didn't know that you were here. I would have been careful much
No,
more.
no, I just got up after a small nap. Sorry. So the word claim, you last explained.
Yeah.
If suddenly some three examples I'll give. One is retrospective law.
Hmm.
Two is arbitration up and down, going back, goes back to arbitrator again. And third thing is some criminal proceedings initiated and acquitted, then again they say convicted. So how does the word claim can be interpreted in that context?
See, claim are given, in fact, you are perfectly right, because claim uses the word whether reduced to a judgment or not.
Quite right.
So when it says whether reduced to a judgment or not, it doesn't matter whether it's a civil case, criminal case, or any matter or arbitration award.
Yes.
Until then, what happens is, in fact, in practical situation, if I may say, when an arbitration is already pending, it's a pending proceeding which gets included in the insolvency resolution process. So if I'm supposed to get, let's say, 500 crores from the state government or the central government for the dues for which I've done, which I've seen in some cases, the arbitration will be going on. This will be treated as a receivable in the valuation process for the plan. Now the resolution applicant takes the chance because the resolution professional is saying this is a receivable, so my company is now worth 500 crores. Now you pay me the highest best offer for this. Now the person offering is taking the risk of this judgment which will come in his favor, and after that the section 34, 37 Supreme Court. So there are people who do take that quote unquote risk to treat that definition of claim, which is under which the asset is valued like a contingent asset. So this would be my answer for that question which you're putting in regard to a judgment. So far as, can I just have the first one or two situation, first situation which you asked me?
Retrospective amendment.
Retrospective amendment, no, absolutely no. We have not seen such a situation here in regard to the plan, at least I should say, because you will see that the context of my presentation will stop with the plan. Now, if you got a plan, first of all, you saw reassessment itself should not happen is what they're saying.
No. What I mean is the Income Tax Act 2025 is coming on 1/4/26.
Yes.
Now the transitional provisions are confusing. Now, how do you react in that?
Absolutely.
Is it a claim or no claim at all?
If the government decides to do something and amend to ensure that they're going to make some liability of 5 years back payable today, I will tell you it completely defeats the purpose of IBC, because the person taking over the entity has taken it over thinking that, as I told you, the Hydra head, forget the Hydra head only from the liability angle, and also from the legislation angle, he should be clear.
Quite right.
Don't think the department or the policymakers will be, I would say, completely non-cognizant to the fact that they're going to give it on a new person. Because the whole purpose for IBC itself was, you give it to somebody else other than the original owner, so that the old fellow who is supposed to have run the company badly or run it down is not given it back, except in MSME cases. So I would rather say it's a huge policy level view which you are asking me. But if the government does it, it's going to have a huge impact. And the interpretation
Lastly,
also comes.
lastly is 138, for example.
Yeah. So
It's really
138,
going to be a chaotic thing.
yeah, 138, I would request you to see in the case of, I'm doing that case right now. I'm forgetting.
I thought I read it. I'm not too sure about. Is
No,
it not Adani?
It was Justice Kaul's judgment.
Not
Please
Adani.
judge, you should see that judgment where he said that if the promoters are facing, they must continue to face it. The moratorium won't stop them.
Stop them.
So the persons who have suffered, they can't try to escape it and they should continue. But it will not be a liability on the company, the check amount.
I see.
The criminal
Personal
prosecution
liability.
against the old promoter who signed the check, he must continue to face it.
Yeah. So thank you very much. You did very good job.
Thank you very
Excellent.
much. Thank you.
Pleasure.
Thank you, Jayakumar sir. So we'll take next question from Mr. Arvind Rajagopal and thereafter Mr. Gautam Ramvittal.
Yeah.
Subject to time, sir.
I think Arvind came on the screen and he was.
Yes, sir. I had device problem.
Please.
Yes, sir. My question is I actually have two questions. If I'm asked both, it will be very short.
Please.
First, while during your lecture, you had remarked that the concept of clean slate principle is not a legal principle enshrined in the IBC itself. Rather, it is evolved by the Supreme Court only in Gyaneshwar Mishra. So even if it is such a principle, it should be whether it should be confined to the sections 31 and 32 capital A. If at all, it should be. That is my first question. It should not be brought beyond these two sections is my first question. Second question is with respect to 32A as such. Here it is relieving the liability under offences for committed prior to the CARP for a new management. In case whether there is any stoppage in IBC where if a new management for the namesake is brought into operation for 5-6 years they run the show. After that, old management steps into the shoes. Whether there is any possibility for prosecuting them subsequent to this passage of time. These are my two questions.
See, the first question, you're right to an extent that the issue of clean slate theory is no doubt judicially enunciated. Therefore, it applied to the resolution process. But we have expanded it and now we are using it also for liquidation purposes also. Whether it's right or wrong itself is a different issue. But the NCLT and NCLAT are also recognizing it. I support that view because there's one, if I may take just a few seconds more, the context of IBC itself is cash oriented. A person will receive whatever his money is in the form of payment. He will not get an asset like in the winding up process. So today, if you have to get any money, the question of municipal authority going and trying to attach the property and saying my tax dues are there, NCLT, NCLAT, Supreme Court all say no, sorry, there cannot be any attachment. In fact, the property is sold without any encumbrance because the purchaser should get clean title. If you want, go and file a claim for that, and if you are liable for tax, you get tax amount in the claim. So therefore, in that context, the property which went out is a clean slate. That's why I'm saying in olden days, Mr. Pramod Chopra, all of us from the 80s know that buying a property from court auction will give a clean title. We used to have a impression in those days. Today, buying a property from insolvency gives absolutely clean title. I think Arvind, you will accept because people who come there buy because no other claims can come from insolvency sale. That is why we have given a legal word called clean slate theory for that. You get a property or any asset or any business clean. But now for liquidation also that is happening and that is right. In liquidation, anybody who has to get a money is only to get it under a waterfall mechanism, which is money. Only in voluntary liquidation, you have the in specie distribution, which is the shareholders themselves will get the property and walk out in family companies. That's why I didn't explain that too much. That is the answer to your first question. Second one was in regard to, I forgot that question.
32 capital A of the section of the IBC.
32 capital A. See, 32 capital A, what he gave, let me tell you honestly, why to wait for even 5-7 years? Half the time we see that the promoters themselves have set up a new RA and he takes it over and these people stay out and run it. So if it is found that this resolution plan itself is out of fraud, the whole plan can be struck off and they can even be prosecuted. It's like section 65 of the code where the insolvency has been initiated for fraudulent purposes. If they can be punished, the creditor himself. imagine what is the punishment they can be given. 100% they can be pulled up also. Yes, I agree with you.
Thank you, sir. Thank you.
Thank you, sir. Sir, subject to your time availability, sir, we'll take
No
one.
problem at all. How much ever. I'm free for the whole evening.
Sir,
Whoever wants to ask.
Sir, but before that, I think we can conclude the recording, and thereafter we can just have a
Yeah.
open
Okay. So
discussion.
I'll just stop the recording here.
Yes, sir.